Welcome to Online Trading Campus. This is Jan Skoropinski with you today, continuing the new 2020 Forex course. Welcome back to Module 4, Forex Expert, Lesson 4, Central Bank Intervention. In May 2020, Jerome Powell, the chair of the Federal Reserve, said, for the first time ever, as a central bank, we have the ability to create money digitally. But how does this work really? And what is the effect on the financial markets? This is something we're going to take a look at today. We have already talked a little bit about QE and central bank intervention, but let us cover this topic formally, including QE or quantitative easing, what it is and how it is used by central banks, not just the Federal Reserve, but also the Bank of Japan, who actually was the first central bank to embark on intervention through QE, and the European Central Bank, and the effect of QE on the financial markets. We're also going to talk about currency intervention, and we'll look at a few historic examples here too. And we will finish this lesson off with a little bit of a summary. Quantitative easing, or QE, is when a central bank buys long-term securities, such as mortgage-backed securities, treasuries, or corporate bonds. And quite conveniently, the central banks are also the ones who can just create the funds needed to purchase these securities out of thin air. This is why people refer to this as money printing. Of course, this actually happens electronically. Here's a quick clip from Jerome Powell on printing money from May 2020 during a CNBC interview.
Simply flooded the system with money.
Yes, we did. That's another way to think about it. We did.
Where does it come from? Do you just print it?
We print it digitally. So we as a central bank, we have the ability to create money digitally. And we do that by buying treasury bills or bonds or other government guaranteed securities. And that actually increases the money supply. We also print actual currency and we distribute that through the Federal Reserve banks.
This is quite an interesting interview because for the first time ever, a central banker explicitly states that they are just creating money out of thin air. The most powerful central banks who are historically known to intervene in financial markets are the Bank of Japan, the Federal Reserve, and the European Central Bank. Whenever they intervene, it creates trading opportunities for the proactive investor. Let us examine the origin of QE and the effects it had on financial markets. This is going to allow us to better understand what is happening today. In 2001, Japan started its first QE programs. The Bank of Japan is the very first central bank to use QE. Japan has actually been in the forefront of innovative ways of monetary policy, including ZIRP, which stands for Zero Interest Rate Policy, which the Bank of Japan launched in February 1999 already. And only 7 years later, in 2006, Japan adopted negative interest rates. But let's go back to QE. To be exact, on the 19th of March 2001, Japan introduced quantitative easing for the first time, which back then was really an unprecedented monetary experiment. This policy was running for 5 years, all the way until 2006. And when you look at the Japanese Nikkei index from 1985 to 2001 or even to today, you will really understand why. In 1990, the Japanese stock market hyperbubble collapsed, and with that, the Nikkei went into one of the worst and longest bear markets that have ever been recorded in history. The result is known as the lost decade. However, to me, this looks more like a 3 lost decades in 2020. As you can see, even though the Bank of Japan had launched QE, the market still dropped until 2003. Now, however, in 2003, this was the bottom for the Nikkei for the next few years. And as a result, the Japanese Nikkei went into the longest bull market that the Japanese stock markets had seen in 20 years. So clearly, QE now started to work pretty well. In 2006, the Bank of Japan ended QE, and with the 2009 housing crisis in the US, also the Nikkei suffered major losses, even breaking the previous 2003 lows. In April 2013, the Bank of Japan under Governor Kuroda restarted the QE programs. They claimed to have changed and innovated QE. They called it QQE, quantitative and qualitative easing. Bank of Japan restarted the QE programs, and only then, once again, the Japanese stock markets managed to rally. And for the first time ever since 1990, also created a higher high on a higher time frame. So the intervention and measures taken by the Bank of Japan through QE were evolving and becoming more effective over time. Today, Japan is again in the forefront of monetary policy. In 2010, the Bank of Japan introduced an ETF, exchange traded fund purchasing program. This program is designed to buy ETFs that track the topics, the Nikkei 225, stock average, and the JPX Nikkei 400. While the Bank of Japan had slowly upped this program every few years, they recently announced in July 2020 to purchase 6 trillion yen worth of ETFs per year, almost double the previous rate of 3.3 trillion yen per year. This is the equivalent of close to 56.6 billion US dollars per year. This is on top of QE Unlimited. This opened the door for other central banks to experiment with QE as well, like the US Fed and Europe's ECB. Towards the end of 2008, the Fed introduced QE for the first time in the US, launching really 4 rounds of QE. Why? Well, because at that point, the common expansionary monetary policy tools had reached their limits. The interest rate was already set at close to 0% at that point. As a result, QE became the central bank's primary tool to fight the housing crisis of 2009. Until 2020, this was known to be the largest expansion from any economic stimulus program. QE added almost 4 trillion US dollars to the money supply and the Fed's balance sheet. Until 2020, it was the largest expansion from any economic stimulus program in history. The Fed's balance sheet doubled from less than 1 trillion US dollars in November 2008 to 4.4 trillion US dollars in October 2014. In March 2020, the Fed once again doubled their balance sheet with what is known as QE Infinity. This is because the Fed introduced unlimited QE without a definite end date. This is now the biggest and quickest balance sheet expansion that was ever recorded in history. While they added $4 trillion over the period of 5 years before, the Fed now added $3 trillion in a period of months. Now let us look at the SPY chart during those periods. This is really where it gets interesting, guys. At the end of 2008, the Fed introduced 4 rounds of QE until the end of 2014. The interesting effect this has on stock markets goes without saying. With the running QE program looking for monthly demand, there were quite a lot of awesome buying opportunities right at the beginning of the major 2009 to 2020 bull market. Look at this amazing dynamics. The next phase of QE Infinity started in March 2020, and look at price back then. Price was in monthly demand and very close to the highs of where the previous QE ended. So clearly, the Fed, as an institutional participant who's buying low and selling high in the financial markets, didn't want their previous accumulated assets to show losses. So they pumped in more money and probably panicked also a little bit as they were expanding the balance sheet by more than $3 trillion in a matter of months, as opposed to $4 trillion in the matter of 5 years from 2009 to 2015. The problem we have now, as opposed to back then, is that there are very few high quality monthly demand areas that have been created in the process. But this can now be applied to stocks as well. Looking at the strongest stocks like Apple or Amazon, the ones where the most money flows into, and this is what we now want to buy. Knowing that the Fed is still intervening and potentially going to continue to intervene for a longer period of time. Here on Apple, for example, we now have a nice weekly demand that have been created at the breakout area, so-called flip zones. And we would be trading this in the context of an uptrend as well. Now the last one on the list, the European Central Bank, the ECB, only launched the first QE in 2015. It agreed to purchase 60 billion in euro-denominated bonds, lowering the value of the euro and increasing exports. It increased those purchases to 80 billion euros a month. And in March 2020, similar to the Fed, also the ECB launched the latest QE. They called it PEP, Pandemic Emergency Purchase Program. This was communicated to have an overall envelope of 750 billion euros, buying private and public sector securities to counter the serious risk the euro area faces by the outbreak and escalating diffusion of the coronavirus. This is the biggest European QE program to date. Now let us again investigate the effects this has on major European indices like the German DAX. Once again, it is fair to mention the effects QE has on stocks is very bullish or positive. In 2015, we can see very well that when QE was launched, it created demand, and once price came back into this area, price rallied into new highs. Now in December 2018, the program ended, and with that, stocks also began to shake and struggle. And only in March 2020, the ECB launched another QE program called PEP. Again, isn't it convenient that the ECB launched this when price was low and right about the levels price was trading when they first launched QE in 2015? There's one last topic on central bank intervention, the so-called currency intervention. Currency intervention is when a central bank intervenes in the future value of their own domestic currency. In other words, when a central bank buys or sells huge amounts of their own currency in the Forex markets with the effort to influence the exchange rate. In doing so, a central bank would artificially control the depreciation or appreciation of their own currency. This obviously influences the economy as well. There are two ways on how the central bank can manipulate their own domestic currency, either through direct or indirect intervention. The direct intervention, the one we just talked about, is conducted through massive amounts of foreign exchange transactions, buying or selling. And the indirect intervention is usually based on certain policies that could change the course of the currency. Currency intervention, just like QE or any other central bank intervention, are also windows of opportunity. Let us look at a few examples of currency intervention. In 2012, the Bank of Japan, again Japan, yes, BOJ, had intervened in the value of their own domestic currency, the Japanese yen, in the attempt to weaken the Japanese yen. And this was not just an attempt, they were quite successful with it, as you can see right here. This is a direct intervention, as they were basically selling billions of US dollars worth of their own domestic currency, and as a result, the USD JPY skyrocketed. What does the proactive investor do? Look for demand and buy USD JPY. Also, another famous currency intervention has been done by the Swiss National Bank, the SNB. This happened on the 15th of January 2015. Some of you may remember this, especially if you are from Switzerland, Austria, or Germany. This day is called the Swiss franc debacle. It's quite amazing when you look at the charts during this time. Here, in just a matter of hours, the Swiss franc rallied by more than 2,000 pips. Or in this case, USD CHF dropped by more than 2,000 pips. It was such a crazy day that even a lot of brokers back then went bankrupt. This was not a direct intervention. This was an indirect intervention, basically through monetary policies. On that day, the Swiss National Bank announced to end the Swiss franc's peg with the euro. And also look at these levels. Lots of unfilled orders. First time price comes back up, nice selling opportunity. Second time there's no more supply, but once it created more supply within this area, this worked out quite well again and again, even a third time. In summary, central banks are the most powerful participants, not just in the Forex markets, but also in all other asset classes. They like to intervene, and when they do, we perceive this as an opportunity. In the history of QE, without fail, QE has led to inflating asset prices of their own domestic stock markets. The problem today is that this further pushes asset prices away from the underlying economy. The new mandate of the central bank, driven by the COVID-19 depression, is simple: fund everyone, everywhere, and especially keep stock prices high, regardless of whether all this debt is ultimately bad in the long run. Considering it has taken even higher amounts of debt to kick the can down the road. The only question left to ask for the proactive investor is, does it work? Well, I guess we can answer this by looking at the past, and we just saw that recessions are controlled by the Fed, and at least the effect they have in the stock markets are limited. And while asset prices further divorce themselves from historic, empirically measurable fundamentals, fact as of now is that reality is what the central banks like the Fed does and what the Fed continues to do. Tigers don't change their stripes, and the more the economy is shuttered, the more the central banks will pump into it. Alright everyone, this topic is extremely relevant in today's trading and investing era, as asset prices are manipulated with constant intervention by central banks. This is something we just need to have on the radar, as it influences most assets. I will catch you all for the next lesson. Until then, thanks everyone, and happy and safe trading, and ciao.